But Sebi is proposing a new asset class, which would be a hybrid product combining features of mutual fund plans and portfolio management schemes. To discuss more on this, Radhika Gupta, MD and CEO at Edelweiss Asset Management, is joining us. Radhika, good morning. Always great speaking to you, and bright and early this morning. First, just explain to our viewers, right? Do the norms allow enough flexibility to offer higher risk-return products? And what does this really mean for the industry?
I think it's a very good development for the industry. Essentially, you have had mutual funds on one side, which are very constrained in what they can do. And then you have had flexibility on platforms like PMS, PMS less so, and more so AIF, particularly in terms of, and the flexibility, Sonia, is around few things. One is around exposure to derivatives, which these norms open up a little bit. We can talk about the details. Second is around flexibility with respect to redemption, subscriptions, etc. So you can't run a closed-ended credit fund, for instance, on a mutual fund platform today. These guidelines, as I've seen, at least prescribe flexibility to do that. So I think the intent is to create a product that is midway between mutual funds and PMS AIF for a slightly more discerning consumer, which is why you have the 10 lakh ticket size in place. And globally, I mean, I remember in the US, these were 1940 Act funds, or they were called liquid alternatives. So it is in some sense a natural evolution for the Indian market. From what I see of the reading, there is some flexibility it provides. For instance, AIF allows you 200% exposure. This allows you 100% exposure, but you can use derivatives for the purpose of investing, not just hedging. So it's a little bit of midway. The amount of exposure and concentration you can take in credit portfolios, for instance, is not as flexible as AIF, but it's more flexible than mutual fund. So I would say the flexibility is midway between the two platforms, which is probably where it's intended to be.
Okay, that's very well explained. And of course, it's always very helpful, right, for the industry to widen and newer products to come in because, you know, we've seen this whole industry evolve quite a bit over the last many years. But I want to ask you, this new product, will it take away from traditional mutual funds in any way?
I would not think so, because if you look at the traditional mutual fund platform, I think today out of the 60 lakh crore industry, 35 lakh crores is dedicated to vanilla equity or hybrid solutions, and a large part of that is the retail investor. I think the products that will be created are incremental to that. So as I read through this, I come from an alternatives background. 130-30 or a long short equity fund or a credit fund, these are still satellite products for the consumer's portfolio. I think the core proposition of mutual fund in terms of strong equity offerings, index funds, etc., I don't think that goes away. I think this is an incremental addition. It's opening up the market. In fact, what it might take away, Sonia, from is a traditional AIF offering, because the taxation treatment, I suspect, for something on this platform will be far better than doing something on the category 3 AIF platform. So if anything has to be challenged, I suspect it will be that side of the equation, and the ticket size is much lower.
And you're saying that the 10 lakh investment threshold so far, what they've announced is fair. You're not, there's no complaints on that front. And also on the eligibility criteria, anything else that you want to add?
Well, I think it's fairly flexible. You have enough flexibility for a new entrant to enter, provided you get a fund manager with whatever that 3,000 crores of AUM is. I would say it is difficult to find alternative managers who manage that size of money, at least in the equity kind of space in India on alternatives, but you have that flexibility. And if you're an existing mutual fund player, I think 3 years / 10,000 crores is a very comfortable threshold. So I don't think there's a challenge whether it's new entrant or old entrant. I mean, SEBI's left the playfield quite open for multiple players to enter. In fact, I suspect you'll see more players queuing up for mutual fund licenses.
Radhika, morning. I can't. Budget is 3 days away, 3 sessions away, actually. Good to see you. What's the on every year without fail, like clockwork, this taxation talk? Anything you're hearing?
I am hoping to see, I mean, IMF has made a list of representations. I am hoping to see some changes as far as mutual funds on 2 fronts. One is that last year, the fixed income taxation was, it was a surprise at the end of the year. So some relief on that, maybe in part. The second is, as a consequence of that fixed income taxation, Prashant, if you remember, there was a change in the taxation of funds and a bunch of other structures that I think just was a strange casualty of this. So I'm hoping some corrections in taxation will be there. I know you guys have been buzzing about the whole equity capital gains thing, but I think we're all hoping that given everything that's happened over the last 2 months, we don't see too much of a change in equity capital gains tax. That would be a little disruptive, I think, at this point in the market. Personal taxation, I think, is another place, of course, where one expects some relief for the middle class.
Well, we hope, and then we get what we get. But great conversation, Radhika. Thank you very much for joining us, and we'd love to have you back once we have the details and if something does change in the budget in terms of taxation or otherwise. So that's Radhika Gupta with her perspective.